Hello, hello. All right, happy Monday. If you guys were not here for our training at 9 o'clock Mountain Standard Time, welcome. Great to see you. Happy Monday. If you were in our 9 o'clock training, then welcome back. Nice to see you. We talked about the CARES Act, and which we've talked about all year, right? But this was about borrowing from or taking out from your retirement this year and the different provisions that were made to soften the blow of having to borrow from your retirement this year. So if that interests you or that's something that you're curious about, check out today's live. Yeah, I am going to give everyone a few minutes to get in because, well, it's a Q&A session. And so I need your questions in order to have some content. I do have a couple questions that were asked in my money, tax, and finance group this week that I will be happy to answer, or that I will answer to kind of not kill some time, but take up some time. But please, as you guys jump in, say, hey, hello, hello. And whatever questions you have, please put them in the chat so we have some content for today, right? It's all about, this is like your access, your free access to me, you guys, whether you're a client or not. Ask away, ask those questions. They can be PPP questions, EIDL, unemployment. I can help as much as I can. They can be just tax questions. They can be just accounting questions. They can be anything that you have questions about, right? Anything you're having trouble with, anything you're not quite sure about. Maybe you're doing something a certain way and you're just not sure it's right. Whatever it is, I'm here for you. So welcome as you guys are jumping in. Do let me know that you're here. Say hey, let me know where you're watching from. I love to see everyone across the country. Excuse me, I don't have COVID. If you were on our live at 9, you know that. Those of you that weren't on our live, my family's on quarantine because I was exposed. We're on day 12 of our 14-day quarantine, but I did go get tested last week and tested negative, and we all feel great, but we're just doing our part to be careful, be safe. So, and those of you that know me know that I live my best quarantine life. I love quarantine. I love quarantine more than I love seeing people. It's terrible. It's not terrible. That's just me. So as you guys are jumping in, go ahead and start putting your questions in the comments. Whatever questions you have that you're here to ask, feel free. Please answer them. There is no such thing as a dumb question. I know a lot of people, they get timid and they're like, well, I'm sure this is something everybody knows, so I don't want to ask it and feel dumb. That's not a thing here. Okay. We don't make you feel dumb. Our communities don't make you feel dumb. We recognize that y'all don't know what you don't know. That's why you're in this group. That's why you're following this channel. That's why you're here, to learn. So please put those questions in the comments. I do have a really good question that was asked earlier this week, I think in my money, tax, and finance group. So the question is, I don't know, let me jump. It says, I am wondering whether it would be better to start a 401k for my business and save as an employee of my business with a company match, or establish my own individual IRA. Okay, so this is a really loaded question, and this will give everybody that's here plenty of time to type in their own questions because this one's loaded. All right, so when you guys, as a business owner, okay, as a business owner, you have additional options for retirement that are specific to your business, that allow your business to make contributions to your retirement rather than you individually. All right, most of them also, there are also individual components to different retirement plans. And so it's important to know that there's a difference there. All right, so she says, here, let me put this. No, I won't because I've done that before. But she talks about, should I start a 401? She specifically says, would it be better to start a 401k for my business and save as an employee of my business with a company match, or establish my own individual IRA? So we will talk about, there's two pieces here, right? There's you as the individual, either as you consider like the employee in your business or the individual, if you're a Schedule C there's the business contribution to retirement and then your individual contributions to retirement. So we're going to kind of separate those two things into two different pots because they are, no matter whether you're a business owner, a Schedule C business owner, an S Corp business owner, a partnership, whatever, there's two pieces. So let's start with the business side, because that's where the biggest deductions come from, because the business contribution limits are really, really good on solo 401ks and SEP IRAs. These two types of accounts, that don't know if you can hear that, but sorry if you can. It sounds like a tree saw. We're only going to talk about solo 401ks and SEP IRAs, and the answer to this question, you guys, there are a lot of other options, and if you have employees, there's other options you're going to want to pursue, but we're talking about these because I'm answering this specific question. So, so solo 401ks, SEP IRAs are sole in many aspects, but different in a few very important aspects. Okay, so solo 401ks are available only for sole proprietors. Okay, you cannot have employees. If you have employees in your business other than you or your spouse, you don't qualify to open a solo 401k. Okay, but if you are a business where it's just you or it's just you and your spouse, a solo 401k is hands down your best option. Okay, it has the highest contribution limits for the business. It has the highest contribution limits available for you on the individual portion. So it has the most tax savings in this year, and it still has low fees as opposed to opening a regular 401k. Okay, because that's the thing. If you open a regular 401k, whether you have employees, no employees, there's a lot of reporting, and so there's a higher admin fee when you open those regular 401ks. But a solo 401k, if you have no employees other than you and or your spouse, solo 401k is money. All right. So both the solo 401k and the SEP IRA, they allow you to make a contribution of up to 25% of your earnings. So if you're a W-2 wage earner in your S Corp, then your business can contribute up to 25% of your W-2 wages to the solo 401k business deduction. Okay. If you are a Schedule C business owner, then it's 25%. And there's actually a slightly different calculation to this, but for all intents and purposes, you're going to use line 31 of your Schedule C, your net profit, to figure out how much you can contribute to that 401k. Okay, and another big difference is that your solo 401k contributions have to be made by December 31st of the year you're making them for, whereas with an IRA, you can make them up till the time you file your tax return. The employee deferral portion, so the individual portion. So everything we just talked about is the business portion, right? But for the individual side, your solo 401k is going to allow you as an individual to contribute up to $19,500 into the plan. So that's above and beyond your 25% that the business made, or the contribution the business made. Okay. Whereas your SEP is going to be limited to, I think this year it's it's 6,000. It's going to be limited to 6,000 on the individual IRA side. All right. The catch-up contributions are higher on a solo 401k as well. The catch-up contributions, if you're over 50 years old, you're going to be able to contribute on the individual level an additional $6,500 in 2020. Whereas with, again, that individual IRA, your catch-up is only $1,000 additional. Okay. And then the solo 401k plans allow for a Roth contribution. And SEP IRAs only allow traditional pre-tax contributions. So we will go into a whole thing about, we have had trainings about Roth versus non-Roth and how those pieces all go together. Okay. Oh, perfect. This is Amina. So she says my business is set up as a C Corp, but right now I'm the only employee. Okay. So same thing then. So it's going to all be based off of, sorry here. Your name doesn't show up, but I know it's Amina, because, and I hope I'm saying your name right. Let me know if I'm not. But she's set up as a C Corp. So y'all, C Corps are a little different, and we've talked about it. So, but big picture for what we're talking about today, everything's still going to apply to you. All right. Excuse me. And then there is a loan provision on 401k. So that solo 401k is going to allow you to take out loans from your from your 401k balance. It's equal to the lesser of 50% of the plan balance or $50,000. And you can't take out loans against your SEP IRAs. All right. So here, the thing is, if you are the only employee or it's just you and your spouse, solo 401k, it's the way to go. It has higher contribution limits with the same benefits as a SEP IRA. If you have employees, you're disqualified from a solo 401k. But if you're willing to make the same percentage contributions, the business, to your employees' retirement accounts as your own, then a SEP IRA is a great tool to help you do that. All right, so Ellen, hi Ellen. So Ellen says, I live in Georgia and our town was hit hard by Hurricane Zeta, tropical storm by the time it hit us. We had a tree crash into our house, into our bedroom. Lots of damage. I am so sorry, Ellen. So sorry. So the family's okay, good. My question is there some kind of tax break if your house gets hit during a hurricane disaster? That's a great question. And what will happen is there is. The answer is yes, usually, but the federal government has to announce it. Okay, they have to announce that Hurricane Zeta, so the government announces it, in the IRS they work together. Okay, so in the past, and I'm so I think it was it 2017 or 18 when Florida and Texas were hit by I think 2 or 3 different hurricanes. So when that happened, the government and the IRS and all the other people, so I sound really politically knowledgeable, right? But they announced it a natural disaster, and then they announced, they said, yes, there will be some relief, but the relief changes. Okay, some I just can't remember if it was 2017 or 18. So I'm so sorry. But when the last time I had to deal with this with our clients, the biggest thing was that they had an extension of time to file their tax return because it hit during I think when tax returns are due. But in terms of actually getting a tax break, that one didn't use it. So, but where the benefit's normally going to come when it's a natural disaster is from, FEMA relief, EIDL loans, right? So you guys, EIDL loans were a thing. This is personal though. This is personal. So let me not get off track. So it's your residence. Hopefully your insurance is going to cover it. I'm guessing though you have some sort of deductible. And so you have to look. I'm just going to look. I doubt they have it already. They've announced anything, but I'm still going to just look for that. I'm not just guessing. Although I'm good. 2020. Let's see. Yeah, Georgia, so because a lot of times there will also be state, there might not be a federal, so there might not be a federal tax break, but a lot of times there'll be some sort of state governance as well. So make sure you check with Georgia as well. So Ellen says it will cover, so insurance is going to cover most of it, so you're concerned about the rest. Ellen says I didn't know if there's some kind of depreciation for damage. That's something, no. That I can answer. Now you're speaking tax like old stuff. So what'll happen though, Ellen, it ends up working out of your favor. So let's say you bought the house for $300,000. I'm trying to make math easy. $300,000. Okay. They are going to depreciate that value. They'll appreciate it, but they'll also figure out when they're coming up with the value of what the insurance company of what they're going to pay you, they do take depreciation of your house into consideration, as well as I believe appreciation. This is all insurance, not tax, but I got you. So when they value what they replace it for. So, so the question is, I don't know if there was some kind of depreciation for damage. So there isn't. And in fact, when all is said and done, because I mean, and it's a personal residence, so there's not going to be any piece. If it's a business, if you owned like a business property, right, and there was like a fire or something, then it's a little different. But when it's just personal property, there's not a tax depreciation aspect to it. Everything runs through the insurance, and that's that. I made that way more difficult than I needed to. Sorry. Let's see. Oop, I scrolled too far. Okay, so I got you. Let's see. Okay, so I don't see any other ones in the comments. So let me know, guys, if you have other questions, but I have a few other ones. Let's see. These are ones that I wrote so long ago. I got to make sure that I can actually answer them for you. Okay, so I did have, so I had someone ask a question about reasonable compensation. What is, I mean, it was very general. It's what is it? When do I have to take it? I keep hearing this reasonable compensation. So if you are the owner of a corporation, whether it's a C Corp or an S Corp, okay? If you are an officer of a corporation, of C Corp or S Corp, and you work in your business, meaning you do something in your business that helps your business run, then your corporation, your C Corp or your S Corp, has to pay you a salary. All right, and the reason for this, from C Corp and S Corp, are two different reasons. Because for my C working officers tend to try to inflate their compensation because they want to take as much money out of their business that isn't a dividend, and subject to that, you always hear double taxation. Double taxation applies to C corporations, and it's when you take profits out of your business, right? You get, the business gets taxed on those, and then you get taxed on them when you take out the dividend, right? And so people, to avoid that dividend, they think that by, they try to increase their reasonable compensation to try to avoid that. I can tell you all the reasons why that's not important, but that's neither here nor there. I know there's not, you're a C Corp owner, but I know there's not a lot of C Corp owners in here. Most of the times when we get this reasonable compensation question, it's for my S Corps or people who are thinking about being an S Corp. And this is why. Okay, so S Corp. Let's say, so your S Corp is over here, it's your business, the S Corp files a separate return, all right? Whereas when you're a Schedule C, it's just a form on your personal return, right? So quick step back. So your S Corp, we file your tax return, we do all your books, and we come to the fact that, or we come down to net profit, taxable income from the business, the S Corporation, of $100,000, okay? And it's just you're the only officer. So that $100,000 of taxable income is reported on a K-1 to you personally. And you're taxed on that $100,000 of net profit from your S Corp as ordinary taxable income. All right? If you're not with me so far, raise your hand, tell me pause. Okay? That amount, that $100,000 that flows through from your K-1, from your business, from your S Corp, that $100,000 is subject to taxable income on your personal return. It is not subject to self-employment tax. What is that? What does that mean? Let's back it up a little bit. So let's say you're not an S Corp yet. Let's say you're still a Schedule C business, okay? And we do the same thing. We take all of your revenue, we subtract all of your expenses, and we come up with $100,000 of net profit, okay? That $100 from your Schedule C business is subject to income tax, right? Just like the S Corp is. But that $100,000 is also subject to self-employment tax, which is 15 point, let's say 6. I can never remember because I always just round it up to 16%. It's just under 16%. So as a Schedule C, if you have $100,000 in net profit, taxable income, whatever it is you want to call it, line 31 of your Schedule C, you have $100,000 on there, you're not only paying your income tax, whatever that is, you're paying an additional 16% of self-employment tax. That means almost $16,000 in self-employment tax. You do get a deduction for half of that, but when all is said and done, that's what it is, okay? Head on over to the S Corp over here. The net income that is reported on that K1, remember, S Corp files a tax return. All of the income is reported on a K1 that is then reported as income on the shareholder's individual tax return. Okay, so if there's one of you, you get 100% of it. If there's two of you, it's split depending on your ownership and your agreement. But for this, there's one of you. Okay, that $100,000 is taxable income to you. Okay, but it's not subject to self-employment tax. Because it's not subject to self-employment tax, there is a caveat. There's a stipulation. There is a rule for S corporations that says if you are an officer in an S corp and you are working in your business, you must take a reasonable compensation. Okay, so that's where the term reasonable compensation comes from. And what that means is we back it on up. Okay, we had $100,000 in that net income. But we have to calculate a reasonable compensation for you as the officer, and your CPA should be helping you with that. Okay, so we figure out there's multiple pieces that go into it. How much are you working in the business? What would somebody have to pay you if you went and worked for a different business to do what you do in the business? What would you have to pay somebody to come in and do what you do in the business? Okay, what is the standard or the industry rate in your area for what you do? Okay, there's a bunch of different pieces that go into this reasonable compensation calculation. For ease, let's say we calculated at 50 grand. Okay, we say 50 grand is a reasonable compensation for you and your business and your industry. Okay, so the business no longer has $100,000 of taxable income. You have to run payroll. You have to be a W-2 employee in your business. Okay, so your business is going to run payroll. You're going to get paid $50,000 in gross wages. The business is going to pay their payroll taxes, their half, and take out your half. Okay, so Schedule C, you're paying just under 16% of self-employment tax. Over here, you're going to pay just under 16% in employee taxes or employer taxes, payroll taxes. That's the word I'm looking for. Payroll taxes. That's covering your employee and your employer side. So that's why the employee side of that, guys, is why your net income or your net wages never equal your gross wages, right? You made $50,000, but we had to, they withheld FICA and FICA, Medicare, FICA, Social Security, your half, okay? And then the business matches that and pays the other half. So the business is going to deduct that $50,000 in gross wages plus their half of employment taxes, okay? So your business income that flows through on that K1 that we just talked about is no longer going to be $100,000. It's going to be just under $50,000 now, okay? But now you have these W-2 wages of $50,000 as well. So your taxable income is going to be almost the same. It's going to be just under $100,000 because you have half of those payroll taxes that are deductible. But, let me close this. But you paid payroll taxes on the half that is W-2 wages, okay? So you satisfied that reasonable compensation. The government got their payroll taxes, their FICA, their Social Security, Medicare, those things, and all is happy, okay? But by being an S Corp, you saved money on those payroll taxes, right? Because you only paid payroll tax on $50,000 as an S Corp, whereas over here as a C Corp, you were having to pay self-employment tax on all $100,000 of income. All right, so you saved about $7,500 in taxes, okay? That in itself, you guys, I just gave you a huge tax saving strategy, okay? Am I telling you to go out and be an S Corp, change your business? Absolutely not, because this is something that varies from business to business. I just talked about one pro of being an S Corp. I'm not talking about all the cons, because there are cons. There are pros and cons to changing to that S Corp status. And it's something that your CPA should be having a discussion with you. Okay, if your CPA ever says, hey, we're going to change you to an S Corp because you're going to save taxes, don't just say okay. All right. they should be having a conversation for you, telling you exactly what that means, exactly what that, because there are now responsibilities, there are different things that are going to happen. There's another tax return to do. There is payroll to run. There is a requirement that if you change to S Corp, right? And then you take away that election, you can't make it again for 5 years. There's a place where being an S Corp is beneficial at a certain point. But if you're in an industry where it goes up and down, it may be super beneficial this year, but what if it's not next year, right? And what does that mean to you? What if you have less than that in amount of income? How do you handle that? Your CPA should be talking about this. All right. Let's see. April. Hi, April. So April says, in that same regard, businesses going from Schedule C to S Corp January 1, accountable plans and how expenses such as mileage, phone, etc. are reimbursed, I feel like is important to understand. Yes. So you guys, easiest way to do this, when you are a Schedule C business, right? Sole prop, individual, independent contractor, any of those things, right? We are taking your standard mileage deduction, right, on your car, or maybe we're taking the actual, but not very many Schedule Cs, at least in my experience, end up benefiting from that actual. Sometimes you do. I'm not judging. I'm just telling you. You're going to take that mileage, whatever that mileage deduction is. That's a business expense on your Schedule C, right? Then you have your home office deduction, right? So you get to take a portion of your home office, meaning, a portion of your mortgage interest or your rent and your utilities and your HOAs and all those things, right? You get to take either a portion of those amounts, or you get to take the standard or the simplified home office deduction, which is $15 per square foot, max at $300. I think that's right. Okay, so you get to take that home office deduction. Okay. Well, when you're an S Corp, okay, you're now an employee. Okay. So you don't get to take the home office deduction on your individual return anymore. And with employees, any of employees, guys. So if you have a job with somebody, this is important because I know a lot of people that have W-2 jobs, right? Even with someone who isn't your S Corp, you work for, I don't know, some big company. I think I could think about this on the fly. And now you're working from home, you're probably like, I want to take my home office now because I have to work at home now, right? I'm required to work at home. So I want to hear about that home office deduction. Tell me about that. Well, when you're a W-2 employee, you don't get to take a home office deduction. Okay, you used to be able to include it to a certain degree under your Schedule A itemized deductions. That went away in 2018 under the Tax Cuts and Jobs Act. So if you are a W-2 employee using any portion of your house for work purposes, you do not get to take a home office deduction. Okay, it's not allowed. What is allowed is an accountable plan. Okay, I'm so glad you brought this up, April. And what that does, you guys, is it allows you to be reimbursed by your business for expenses such as home office use, April says mileage, phone, etc. All right. However, this is a plan that your business, the owner of your company, must set up. So I have found a lot of luck over the last couple of years with clients. So my taxpayers are W-2 employees who work for smaller businesses, where the smaller businesses have been like, yeah, that's fair. So they've been reimbursing them. And then yes, that is more money out of the pockets of the businesses, but it's also a deduction to their business. They've been okay with that. They've taken care of their employees and said, yes, we are willing to do that. All right, whether it's for mileage, phone use, home office, whatever the reason. Okay, and then you have nothing to report on your tax return because there's no longer, you don't have to itemize. You're not trying to get a deduction for it. You've been reimbursed. Okay. So there's nothing for you to do on your end, but your business has to set up this accountable plan. So circling back around to the S Corps, when you're an S Corp owner, you can set up an accountability plan or accountable plan to allow you to reimburse you as the individual for your home office, for your phone usage, for your mileage. And that is the best way to do these things, you guys, because home office, we explained, phone, that's good. I'm trying to think, but for mileage, you guys, unless your S Corp owns the business or owns and uses the car 100% for business, meaning you have another car that you use for personal use, okay? There's a personal use component to that vehicle, okay? And it has to be accounted for. And an accountable plan is a great way to do that. So April, that was awesome. Thank you for that. Can I like your comment? Nope, not in StreamYard. All right. Okay, well, that was fast. It is 10 o'clock. It is, whew, that was good. That was a quick half hour. All right, you guys. So thank you for joining me. Remember that if, I don't even know, next week, I can't remember what our 9 o'clock Mountain Standard Time training is. Okay, sorry, just can't. But join us for that if you can. Otherwise, here at 9:30 Mountain Standard Time, Q&A update session. Do make sure you guys bring your questions. Thank you, Ellen. Thank you, April, for bringing those. Amina, thank you for posting yours in the group because that's what makes this half hour actually work. So thank you for that. And then a quick reminder that I do not have COVID. I am so sorry. A quick reminder that I don't even remember. That we are in tax planning season. So if you are interested in tax planning services with my team at Breviers and Associates, please visit our website. I'll put it in I'll go back and put it in the description if you're watching this on replay, and check out our tax planning packages. We have 4 of them that have prices on the website. You only fall into one of those 4 plans, okay? There's individual, which is if you don't have a business. There's individual elite, that if you don't own a business, but you had something extraordinary this year to deal with, like maybe a house sale or a stock option or something like that. Then we have 2 basic business plans. One, the light, business owner light, is for my Schedule C businesses. Business owner elite is for my S Corps and partnerships. So start there. Start with one of those plans. Go over there, check it out. Get that started, that process rolling. And then if you're interested in advanced tax planning, whether you're a business owner, a non-business owner, or if you're a C Corp, got to go with those more elaborate plans. Then we do some advanced tax strategy, and those are the business owner elite and business owner executive. But again, I would definitely start with those paid plans, get the basic tax planning going, which basic tax planning is looking at this year, your 2020, looking at your business income, creating a projection for the rest of the year for your business income, what payments you've made in for taxes, and also incorporates your individual as well, because when you're an S Corp or a partnership or a Schedule C, those are all intertwined, right? So includes that, and then we figure out, okay, this is what you're looking at for a tax liability for the year. Here's the basic things you need to make sure that you're doing to minimize that. Then if you want to go a step further and look at some of those creative advanced strategies, then we can do that as well, and we can do it all together. So hopefully the website's clearer than I am in the process. But if you have any questions, reach out to our team. We're happy to answer them and help you out. But otherwise, I will see y'all next week. Have a fantastic week. Bye, guys.